In this video, we will take a look at the next line of defense against uh, retirement poverty. Right, so we started with discussion of Social Security, which is ubiquitous force and at least in the United States in helping people have money in retirement. But typically, this would be supplemented with some personal savings independent of the federal program. And the most common kind of savings vehicles are employer qualified plans, and we'll get into why those are the most common in this lecture. So there's some pretty good reasons, but just overall our objectives are to understand employer qualified plans, what they are, how they work, what do they look like, what are the different types, and then to look at the two different major types. So there's defined benefit and defined contribution, and they look and behave quite a bit differently in terms of what your experience is as being a participant. So why might a company set up an employer qualified plan? Because in the first video for this section, we talked a lot about that people can. One can save for retirement independent of an employer qualified plan, and that the fact that the employer is involved isn't necessarily a good thing. On its face, right? There's no obvious reason why the employer has to be the one that does it, but there's a couple valuable things. So, first of all, the employer qualified plan has some significant tax advantages. So, contributions to some of the employer sponsored plans are tax are made with pre-tax dollars. So this would reduce income tax. It would not reduce Social Security tax, or it doesn't help you with FICA taxes. Very few things do, but it would reduce taxable, like income tax, taxable income. So that's a reason. Often so they may be set up as initially as a retirement vehicle for the owners of a small company. So maybe they wanted to have a retirement through their work, so they set up either a defined benefit or defined contribution for their small business. But then that business grew, and so now you have a larger organization that has retirement policies that it inherited from some a previous decision. Often you can think about competition, right? When employees are thinking about where to go work, often we do pay attention to what are the retirement packages available. I think about the institution where I taught previously. If you were I forget the exact age, I think it was 50, but if you were towards the end of your career and you worked for this institution, if you did an employee contribution to the retirement plan of 6%, they would match you 17% of your annual salary. So that was a huge bump in conversation for people in that program, and that would make working for that institution really attractive relative to maybe other things you could have done, like being in industry. So retirement plans are, good retirement plans are attractive in a way to be competitive in the labor market. So what are required? What are required for setting them up? Generally, there has to be longevity and some stability to make it worth it. Right? If the company is not sure it's going to be around in 6 months, it doesn't make sense to invest in creating one of these. Also, the different vehicles have different back end sort of effort required, but in general, all of these require some work to administer on the employer side. And we're probably very familiar with this, right? Is if you have a job and you're participating in an employer qualified plan, or if your employer has one of these plans, you probably have gotten emails that say, oh, a benefit specialist is here, you can come talk to them, or you had the meeting with HR to help make your benefit elections for the year, right? So there's a lot of infrastructure that happens, and then there's reporting that happens. There's a lot that goes on to make this work. And so there's some effort that's required to have a successful employer qualified plan. Now, for small businesses, there are special plans, SEP and simple plans that are for smaller businesses. But for a full plan, there's some pretty significant organizational requirements to make it happen. So within the universe of employer qualified plans, there are two broad categories. The first is defined benefit, employer funded pension plans, or defined contribution, employer sponsored retirement plans. So those titles are actually significant. So when we say defined benefit, it means that the benefits to the retiree are defined by the plan. So the future retiree, current employee, has a benefit in the retirement that's defined by the plan. So the payments in retirement in some way are defined by plan policy, right? That is in contrast to the defined contribution plans where the amounts contributed every year are defined by policy. And this matters because if I'm an employee and I have a defined benefit, right, I'm promised a certain payment in retirement, it's on the company to figure out how to invest to make sure that benefit happens, right? Where in a defined contribution plan, the defined part is how much is put in that case, right? The contribution. And so it's a lot easier on the employer because their job is to just contribute what they said they would contribute, and that's it. The management after that is either is generally outsourced, and it's to some degree on the responsibility of the employee to decide how to properly manage those contributed funds. And so, in effect, it forces the employee to take more ownership on how their retirement is handled. Which is generally more right. It's easier on the employer side and more effort on the employee side. But there's some advantages to the defined contribution plans other than just being easier for the employers, especially when it comes to portability. Right? If I have a defined benefit plan and my company promised me some dollar amount in retirement, well, what if I decide to change jobs? Does that all go away? Maybe I don't like the way the formula is done, or maybe, what's even scarier is maybe I don't trust that the company is smart enough or wealthy enough or willing enough to contribute what's necessary to make the benefits happen. So they promise the benefits, but I'm not maybe that confident that I will get them because the assumptions behind planned investment are too aggressive, right? So maybe the employer is assuming a 14% annual return, and it's just not reasonable given any sort of normal risk profile. But if their contributions make those kind of assumptions, it means their contributions will fall short. And this is, a common concern at a lot of levels that these defined benefit plans are not funded to the levels they should be, and that puts benefits at risk. Whereas in a defined contribution plan, benefits can be at risk as well, but they're at risk of having returns that are too low to meet the retirement objectives given the contributions that were made. But the worry that the employer will renege on contributions is a lot smaller because the contributions are made consistently over time rather than secretly in the background. So all that, we can sort of distill it down to a couple major differences. So in terms of employer contributions and a defined contribution plan, right, per the title, it's specified for a formula, it's set aside, it's defined, right? So we define the employer contribution in the plan. And this constitutes, and in many cases, this constitutes some kind of matching arrangement where up to 2% of your personal contribution to the employer plan, the employer will contribute dollar for dollar what you did. Or if you contribute 6%, the employer will contribute 17% or 11%. Whatever it is, there's a formula that specifies how much the employers contribute. Right? That's very different from a defined benefit plan where the benefits are set, right? And that means that it's on the firm to determine actuarially, statistically, how much needs to be put in. So they say, oh, well, we promised Steve a defined benefit of $2,800 a month. Well, how much do we need to be investing now to make sure that we can pay the benefit we promised Steve, right? And that it matters a lot on how long Steve lives, and so there has to be, some calculations done based on the health of the working pool and the number of retirees and so forth, and to come up with reasonable contribution. And you can imagine that employers are happy to maybe be a little aggressive with assuming earlier death dates or higher, typically, a really common one is higher asset returns, and with a high asset return assumption, it means that the contributions can be smaller and get to the same place. And so if a company was looking to contribute less to their defined benefit plan, assuming a better and maybe even an unreasonable investment return would be a way to do that. And there's been issues with that in the past with some firms. So based again on the title, the benefit amount in a defined benefit plan is certain. Right? Often there's, like in the case of a pension, you have a formula that describes what is your benefit upon retirement. In defined contribution, it's unknown. Right? You can we have a nice formula to tell us what got put in, but it depends on the market and the investment mix to figure out what comes out. So that means that the ultimate benefit is uncertain. All that's certain is what was put in. So, and because of this distinction, right, between defining the benefit and defining the contribution, that's going to affect the Internal Revenue Code limits. Right? So in a defined benefit, the limit, right, there are IRS limits on how big these retirement plans, these employer qualified plans can be. And for a defined benefit plan, the limit is described by the maximum size of the benefit. So you can't promise an employee $10 million a year because it's above the maximum allowable defined benefit. In 2017, it's later in the slides, I think that number is $215,000. At the most, a defined benefit plan can promise is $215,000 a year. But it's also limited, I think, by 100% of salary in some fashion too. On the contribution side, IRC, the Internal Revenue Code limits apply to contributions. And now this gets complicated because there are limits in how much can be contributed to these employer qualified plans that are specified and have some dollar amount. But the limits to benefit from certain tax advantages are often much smaller. So when a question you might get is, well, how much can I contribute to my traditional IRA, or how much? To my 401k plan, and the number that you can contribute to the 401k plan and get a tax deduction is different than the number that maybe you get matched for, which is different than the maximum allowable contribution in the year, right? So, for example, if you're trying to build up a lot of retirement savings, you might make contributions above the allowed deduction level, and that would just mean you're making contributions to your 401k with after-tax dollars instead of before-tax dollars, which is allowed. But up to a certain point, even that's not allowed, right? That there's a limit on how much you can kick in. So because the two plans are very different in their nature, the different types within those groups are very different. So for the defined benefit plan, we have two major versions: a pension, a defined benefit pension, and then a cash balance pension. And the over on the defined contribution side, We have a lot of different options, not all of which are all available. So, and some are variable contributions, and some are fixed contributions. So, for example, an employee stock ownership plan is a, a contribution of stock into an employee's portfolio on their behalf for retirement. But if you're working for a nonprofit entity that doesn't have shares, obviously they can't offer you stock in the company because there is no company. It's a nonprofit organization or it's a state and local government, right? So there's no way to do a stock ownership plan because there's no stock to own. But and there may not be profits either, right? Especially if we're dealing with government, so profit sharing doesn't make sense. But for profit making enterprises that have shares and are organized as C corporations, you have those options, right? So there's lots of different types within defined contribution. We'll get into basically all of these, but the nature of the different subcategories of defined contribution is very different than the nature of subcategories for defined benefit. This is a big master chart of all the different things, and you can see there's a whole lot of yeses on here, but there's a couple major areas where we have some restrictions. So if you'll notice, you look under stock bonus and employee stock ownership plans, there's a lot of no's there, starting with partnerships. And what's going on there is partnerships, sole proprietorships, tax-exempt organizations, public schools, and state and local governments do not have shares, right? So they don't have shares to offer in an employee stock ownership plan. And so that makes it, it makes it physically impossible to do that. Over on the right-hand side, we have 3 different plans that fall under the employee contribution plan family, where this is basically the employee is choosing how much to contribute, with maybe some matching funds by the company. In the employee contribution universe, we have a couple different versions depending on the nature of the organization. So 401k would be a more traditional corporate entity, maybe a profit-making enterprise, maybe a public company with shareholders. 403b's plans, they look similar to 401ks, but they're specifically intended for tax-exempt organizations and public schools, right? So Viterbo is a private, not-for-profit educational institution. I have a 403b plan through Viterbo. At my old institution, it was a private, secular educational institution, not-for-profit, and which also had 403b. I know this matters a lot locally, because Mayo Clinic and the Gunderson Health System have a different organizational structure, and so they have you have a 401k in one location and a 403b in another location. 457s work like those two, but they're tailored more for local governments. So if you work for the city of La Crosse, you probably have a 457 plan. But those 3 categories all basically do the same thing. So or similar. So if you look at this holistically between those 3 columns, there's a yes somewhere all the way from start to bottom. So every organizational structure type on the left there has some sort of employee contribution plan that serves it, and possibly more than one. Right? So if you're a C corporation, you might have access to a 457 plan, even though you would typically use a 401k plan. On the far right are the simple and the SEP plans. So those are accessible to all of the different organizational structures, but are intended for small organizations with, I think something like 100 employees or less. So we're going to get into all of these different types of plans, and we're going to start from the left and work our way right. So that's kind of our agenda going forward for this lecture. So this is just a slide describing the contribution limits, right? So I mentioned this before, right? So a defined benefit plan can't promise you more than your salary or $215,000. Now these numbers are changing; they're sort of indexed to cost of living, But yeah, in inflation adjusted terms, they should stay fairly constant. So that's the maximum benefit. Defined contribution, where you're not allowed to contribute more than you earned, or $54,000 to a 403b or a 401k or whatever it happens to be. But again, that number is different than the number that is used for thinking about tax benefit, right? So if you contribute $54,000 this year to your 401k plan, it is a certainty that you will not get a deduction against income for all $54,000 of your contributions. But there will be some portion of that will be deducted, that will serve as a deduction against income. So that's the limits for the participants either receiving a benefit or contributing. The employers are limited in what they're allowed to contribute. So for defined benefits, the employers are not allowed to contribute more than is necessary to fund the compensation, right? So I can't, if I'm a firm, I can't say, well, my retirement plan is a defined benefit plan. It pays the CEO $1 every year upon retirement, and we are putting $10 million in to fund it. It's not allowed, and there's a really good reason why, right? Because funds contributed to employee pension funds, right? Right? These are funds that were not distributed to shareholders, right? Dividend taxes weren't paid on them. In the case of a pass-through entity, you wouldn't end up having income taxes paid on them because it's not earned money; it's paid to employees in the form of savings. So, point is, you could, if you get into some mischief, you could create a nice tax dodge overfunding your pension liabilities, and that's not permitted under the code. But other than that, that's it. So on the defined benefit side, the employer should just contribute whatever they have to make the benefits work out, and that's on them to prove that they're doing that correctly. Over on the defined contribution side, the hard limit is 25% of the participant's compensation. So if more than 25% of the participant's compensation is coming from retirement contributions, this is a problem. It's going to be beyond the limits of what the employer is allowed to do. And these limits change. It's, again, a cost of living adjustment. So back in 2012, we had a lower number for the maximum for these things. And again, the notion is to accept that cost of living increases with inflation over time. And so the type of, if we want to keep the type of benefits that are banned versus not banned constant, then those limits need to be indexed to inflation. So in general, there's been a shift in employer qualified plans. So the amount of employer qualified plans has always been either increasing or staying constant, but that's not true within the two subtypes. So originally there was, if you go back to the mid-70s, there's growth in both defined benefit and defined contribution plans, but not too long after that, in the mid-80s, the number of defined benefit plans declined while the number of defined contribution plans grew. So as a proportion of the total, defined benefit plans are much smaller than they used to be, but it's still common to be a beneficiary of one. But yeah, so there's just some notes on those statistics. So there was 175,000 defined benefit plans in 1983, and that dropped, basically by, what would that be, almost 70%-ish to 45,000 in 2014. So that's a pretty huge drop in the number of defined benefit plans. So again, we're talking about the employer qualified plans because there are other retirement plans that aren't employer qualified. So why do we care specifically about the employer qualified plans? So employer contributions are tax deductible to the employer and are not taxable to the employee in the year given, right? So it's a deduction for the employer, and contributions on the employee side also serve as a deduction for some of these. It depends on the not all, but in general, an employer qualified plan will have some kind of tax advantage, and we'll get to the different types of tax advantages available in the different investment options. And then once we have funds contributed to an employer qualified plan, the funds in that plan are tax deferred until retirement. So if you have investments that are appreciating, and gains are being realized, and new investments are being made, right? And if you were managing your own portfolio, those gains would be taxable, and you'd have to make tax payments. But and that's still true within these plans, but those taxes are deferred. And right back to that first lecture in this section, that deferral means reduced in effect because of the time value of money. So there's just a chart of the decline of defined benefit plans and the ascent of defined contribution plans. So we're going to, again, starting from left to right in that chart, so we're starting with the defined benefit plan. So what are the nature of these? They have some kind of formula that determines the benefit, right? Employees do not contribute or bear risk, right? As you work here, we generate this account for you to on your behalf to have when it comes to retirement, once you've been there long enough. So you get defined benefit plans are, as a feature, include a promise of some defined benefit at retirement. What that promise exactly is depends on the plan and the firm. And within the defined benefit universe, we have two major subgroups. We have the defined benefit pension and the cash balance. So defined benefit pension plans have a salary that have a formula that defines your salary in retirement. So you take whatever your last year of pay is and multiply by the number of years you worked times 2%, or something like that. So the example here is we're matching the final is the average pay times 1.5% times the number of years. So if a person had an average annual salary at the company of $60,000, then in this case, and they'd worked there for 25 years, then their benefit would be $60,000 times 1.5% times 25. So that would be $22,500 a year. But again, that's defined by the formula that's used to calculate it. So what's great about these? Well, on the employee side, right, your benefits are easy to plan for because they're defined, and that's great. And often it's just based on your final salary, so that keeps things simple. And often these benefits packages extend to spouses, so that's good, just for stability purposes. But there's some pretty big disadvantages to defined benefit. It's taxable income, right? If you are contributing to a Roth 403b or a Roth 401k, you don't pay. You don't have taxable income when you do a distribution from those vehicles. If you have a defined benefit, your benefits are taxable income. So that matters. You're also just dealing with the notion that if you have a defined benefit plan, you're at the mercy of what sort of policies the company wants to change with regard to the retirement. So that being a little out of control is a disadvantage. And often we're not doing cost of living adjustments, and so benefits that were adequate when they were designed might ultimately end up inadequate because prices have changed on the system. And this is true, but definitely scary that some pensions are unfunded. So the firm doesn't actually set aside any money to pay the pension. They just pay it out of current earnings. And that would be, there would be a reason to fear the security of that transaction plan. So those are defined benefit pensions. The cash balance plans work a little different. So again, right, this is defined benefit, but now the benefit is a defined return. Right? So if we say your return on your cash balance plan is 6%, and that's just policy and has been for a long time. Well, contributions from the employer go into this cash balance plan, and then those balances earn the stated interest rate, and then also accrue pledges as you continue working for the company. So the company contributes cash balance on your behalf to an account. That account earns a guaranteed rate of interest, which is guaranteed by the firm, and then and then the firm itself has hopefully some benefit from the investment that's done. So how is this different from a defined contribution pension? Right? So in the pension, you have a formula that tells you what your benefit is in each period. In the cash balance plan, there's a dollar value, an observable dollar balance in the cash balance plan that then earns a guaranteed return. And this is a useful feature because then if, say, an employee left and they want to take their accountants with them, it's a very simple thing to figure out in the case of the cash balance plan, right? You have some amount of cash balance in the plan, and so that would, it's a lot easier to think about it being portable because you know what's in there. If you think about a defined benefit plan, of a defined benefit pension, it's more, we promise our employees X, and so we're working behind the scenes to make that happen. And so if so you don't have this nice clean dollar value automatically generated to know how much to allow employees to change job and preserve their benefit. So there are, again, so benefits are that it's not, on the employee side, that it's nice not to have to contribute. It's easy to track benefits because you have a cash balance that's growing in the account that you can observe grow, and then pays whatever the promised rate of interest is. So what are some disadvantages of cash balance plans? Right, you're earning a guaranteed return, which we know doesn't really exist. So there's a trust experience allowing things to progress with a defined benefit plan that isn't, and with the defined benefit pension versus a cash balance, right? And a cash balance, there not as much trust is needed because you have a dollar value that's explicit, and then that maybe you'll take with you when you leave, depending on plan policies. So this is an example of a defined benefit plan at BYU, and a key here, right, is this is that the benefit plan has 4 different distribution options, right? So even within the universe of some kind of accrued benefit, how you receive that benefit is different depending on your election. So in this case, you have one option is to get, once you retire, to get a payment every month or every year until your death. So that's option A under number 1, but there's also 10 years certain in life. So this is you will get at least 10 years, but if you go longer than that, till the end of your life. Right, so that would leave the possibility of bequests, right? That your estate may be collecting some of the certainty period, and that would pass through onto your heirs. Obviously, right, a 20-year certainty and life is better than just life alone, but these all have to have the same value, so the payments for the life annuity will be higher than the payments to the 20-year certain and life annuity. But life annuities are an option. They're specifically for the employee. Then we can have joint and survivor annuities where there's where the annuity is preserved through death of the employee or through retirement of the employee, with different levels of how much the survivor gets. Or obviously, if the survivor gets more, then that would be a less payment overall to make these all equally valuable. And then the last qualified, so the last one, qualified joint survivor annuity, that one is relevant if the employee dies prior to retirement. That might be the only option in these four. So again, this is just an example of how distribution might work under a defined benefit plan. These are not universal, right? So if you end up having a defined benefit plan, or if you had one now, your distribution options may not look exactly like this. But often an election needs to be made. So there's good questions to ask, like the vesting period and what's the formula and how does cost of living adjustment work. Those are good ones. So those are defined benefit plans. So the next are defined contribution plans. So defined contribution plans are a set amount contributed, generally by the employee and the employer, maybe in some mix or some matching arrangement. And so in these plans, the contribution each year is defined, and then the outcome is uncertain because markets move and asset prices change, and so an investment, a defined contribution to an account, does not have a defined outcome because the investment process itself is uncertain. So there's three major types of defined contribution plans. Discretionary contribution plans, this is where the employer has some discretion in how much they contribute. Fixed contribution plans, where there is no flexibility, contributions are set. And then employee contribution plans, where employees themselves choose how much to reduce their salary, and then often there's some kind of formula that determines the employer contribution based on the contribution of the election of the employee for how much they contribute. So within the discretionary contribution plan, there's a couple subgroups, right? So again, these are contributions, a contribution plan where the employer has some flexibility about when they contribute on your behalf to your plan. And so it makes sense that there might be a reason why this exists. So one of the major ones is for a profit sharing plan, right? So we don't want to have to be locked into a particular contribution number because maybe our business has high variability in profits, and we don't want to be contributing money that we should be investing in dark times, right? So a profit sharing plan is a plan where contributions are made based on profits that are available. And so that has a nice hedging effect, right? That when the company isn't doing so well, then required contributions to the retirement fund are lower. And there's also just this general notion of if employees benefit from the firm being successful, then that should motivate or be a positive effect on the workforce. So one type of defined contribution plan is a profit sharing plan for firms that have profits, or organizations that have profits. Right, not all of them do. Similarly, a stock bonus plan is not available everywhere. If your organization does not have stock, right? If it's a university, a nonprofit, or a local government office, or basically anything without shares, then the stock bonus plan will not work because there's no shares to encourage people to own. Money purchase plans are a little different, right? Again, these are discretionary. So the employer contributes a percentage of employer salary each year, not dependent on company profit. So that would feel more like a fixed contribution, but um, but there is right there we're still contributing some percentage of a salary, but there's some discretion about how aggressive maybe they want to be about that. So those are the major groups: profit sharing, stock, bonus, and money purchase plans. And those are all under the discretionary contribution. So this is where the firm has the discretion over whether they will contribute to these and what amount. Right. These next group are fixed contribution plans where the amount contributed is fixed. So the employer matches a percentage of employee contributions to a specific amount, as a potential way to structure it. Now this is a common feature for employee contribution as well, that there's this matching feature, but it can also exist under a thrift savings plan. And then the target benefit plan is a defined contribution plan that establishes a required level to get to a certain level of benefit. So it's, the company wants employees to have a benefit status upon retirement of some amount, or just it's just the nature of their retirement, and then the defined contribution plans establish that level to meet that goal, right? So we define the employer contribution as the contribution that meets this specific target level. So discretionary, but the firm. Fixed contribution, but still the firm. So now we have employee contribution or salary reduction. So this is the employee makes an election for how much their salary was withdrawn, and then the organization, the parent organization, can make some serious discussions about how to there's the employer makes a contribution as well to match the behavior of the employee typically, right? So if I'm an employee, I have my salary reduced to contribute to a retirement vehicle, I may have that matched by my employer. So in this case, employees contribute, right? They're electing to contribute or not in some percentage of their income, and so those contributions are tax. They reduce taxable income. It serves as an income deduction, and so that's again not FICA taxes, not Social Security and Medicare, but income taxes are reduced by this. And this is a really common option. So again, 74 million employees in 2010, 89 million total participate in defined contribution plans. And matching is very common. So as I mentioned before, right, there's the 6-11 match, or a 2-2, 2-2 match, but dollar for dollar. So there's different types of employee contribution or salary reduction plans. So 401k or Roth 401k, all right? So these are plans either sponsored by a corporation or a nonprofit that funds contributed to them are tax deductible. So it reduces taxable income when you make a contribution to these plans. And then because money put in was made on a pre-tax basis, then money coming out from these plans is taxed. So that's the 401k, and that's 401k and 403b. Now the Roth version, right, is the same, but there's a couple key differences. So The Roth 401k, the contributions are not tax deductible, so you pay more tax in the year of the contribution, but you have some flexibility. Once the money's been in there for 5 years, you can take the principal out without penalty. There, there's no, there's no taxes on the principal or the gains upon withdrawal, and so this distinction between a traditional and a Roth matters a lot because you have to think about the relative, tax bracket of the different options. So all right. So what's the difference between a Roth and the traditional salary reductions? All right. So Roth are after tax. Distributions can be made without penalty after 5 years. Roth plans do not have mandatory distributions, but they do if they're rolled over. Oh, wait, sorry. They do not if they're rolled over into a Roth IRA. So if you have a Roth 401k and you roll it over into a Roth IRA, then you don't have the distributions, the mandatory distributions. But again, right, if it's rolled over something else, then you would, because again, the government is interested in getting its tax paid, right? And if you have an IRA that was contributed to with pre-tax dollars, but that the disbursements at the end are all taxed, right? That's tax revenue that would be generated. So employer contributions with Roth plans go into traditional plans, not Roth plans. So if you have a match, right, if you contribute to Roth and get a match, it's going to go into a traditional plan. Roth plans allow you to save more money for retirement because they're, even for the same contribution limits, you end up contributing more to a Roth because you're saving the limit plus the taxes you paid on it, right? So your savings portion of your income is higher because you pay tax and you pay the Roth instead of just paying for the traditional 401k. So you get, for the same contribution limits, you get a higher savings rate for a Roth. So salary reduction plans have some additional features, right? So employees direct funds into these different assets specified by the firm. So there's and this is probably what we're most familiar with, where there's a cafeteria of investment options, and you pick the one appropriate for you from the approved list. And then you're not allowed to invest outside of the approved assets. So this is actually, right, if you think about comparing to, or if I do a Roth 401k, my contributions are post-tax. I have to buy from the list of approved securities. And then at the end, my earnings are tax-free. Versus if I just save on my own, I'm paying with after-tax dollars just like the Roth. I invest them whatever I like. And now I don't, right, my earnings are not tax-free, but, right, per the discussion before, the earnings are, generally tax deferred for a long time because you arrange your sales to not generate too many gains in a given year, and then so you have some control over when those taxes occur, and you also have some control over, you can delay them long enough that saving for them is easier. So what's the advantage of the salary reduction plan? So you get right, so it's there's just a lot more ownership on the employee side, right? So you've made it, you have chosen how much you're contributing, then the employer made some matches. There's this tax advantage in that contributions can either be tax deductible or grow tax free. And so there's a lot of advantages, which is why they're so popular. Not good things are, again, this is defined contribution, so you have no idea what will happen at the end, and also it puts a lot of responsibility on the employee. For example, I've had conversations with, I'm an employee of Whole Foods, and I've been there long enough that I qualify for the Whole Foods 401k, but now I have to pick from my cafeteria of investment options, and I don't even understand what criteria you use to pick on a portfolio, right? So I had that exact conversation in California, and so there is some added complexity on the employee side. So on the employer side, they're pretty easy to administer, right? You just find out whatever the employee wanted to contribute, and then you match whatever they said. There's less government regulation because, again, it's kind of out of your hands. There's no watchdog to make sure that you're making enough contributions to keep the pension funded appropriately, right? If it's a defined benefit pension, then this gets watched, right? And there's some regulation around that. And then there's a lot more flexibility for the employees to shift things around, and so it makes things easier on the employers too, because then they don't have to handle all of that. The employees can do it. So it's still, though, if you're doing a full salary reduction plan, there is some significant administration that has to be done, right? There has to be training on the nature of the benefits. You have to have a way to help people consult and know how to pick their investment vehicles, and so there's work to do, but there's some ease of administration advantage to doing a salary reduction plan. So this is kind of the big gross chart of all these different things, right? So where did the money come from? Is it from the employer or from both? And right, the both tend to be defined contribution, and the employer tend to be defined benefit. And then we have these different categories within the but even defined contribution, we might have a defined contribution from the employer only in these first three, and so there's a lot of different ways, right? So there's a ton of variety in the nature of the contributions and who's eligible and whether loans are possible. And this isn't even necessarily universally true, right? So a 403b plan, it is possible to have the ability to borrow against your balance in the 403b plan, but that doesn't mean that your employer permits it. There is an employer in town that does not permit loans from their retirement accounts for the purposes of purchasing real estate, because they were concerned that their employees would use their retirement money to buy vacation properties during their working life and then not be adequately prepared for retirement. So they decided to not give them the option, right? So there's some company discretion on what they allow their employees to do with their salary reduction plan or the defined contribution plan. So if we think about how does this typically look, so normally we have lots of balances and equities. Again, because we don't have defined benefit, we have contributions, and so we don't have to try to get to a certain number. But generally we're mostly in equities. We have and through mutual funds, you have in your different options of what to choose. Often you get a large stock fund or a small stock fund or an international stock fund or a target retirement fund that adjusts the asset allocation as you get closer to retirement. Usually there's a lot of options, and that means there's some things to consider, but it's the same kind of issue that we think about when we're doing the investment simulation, right? What are the appropriate securities to buy to match my objectives, right? So that question still needs to be asked of these employee qualified plans. With our contribution limits, right, which again this is the, right, so these limits are much lower than that other limit, the $54,000 limit. But that's because, right, these plans have special treatment in the tax law, and so they're more limited in the amount that can be put in. The catch-up column is an extra amount that are for people over age 50. Okay, so another important feature of defined contribution plans is vesting. Not all plans require vesting, but they often do. This is, for example, maybe the company, maybe you contribute 4%, and the company also contributes 4% to your defined contribution plan, but you have to work there for, say, 4 years before you get to keep it. So even though they've contributed money on your half, if you leave after 3, they might just get to take their half of it back. Your contributions would still be there, but theirs may get returned to them. Right? The idea is that if you are just going to take some retirement dollars and then go, we're not going to let that happen. So you have to be there long enough for the retirement to vest and then become yours. Not all employers use vesting schedules, and sometimes they're longer than others. In my last place, there all employer contributions vested immediately. So there weren't any. You had to be there for a year to get the employer contribution plan going. Right? They didn't start it until you'd been there for a year, but once it started, all their contributions vested immediately. And there's 2 different ways that it's often done, right? You can do a cliff where it's you're either not vested or you're vested, or you can grade it and say, oh, every year you work here past the first, you'll get an additional 20% of your contributions vested. So again, don't forget, every year the employer is making additional contributions, so the amount of contributions are going up, and then the percentage of those contributions that actually count and wouldn't get yanked back in the event of a separation go up as well. So what are some major tax considerations of these defined contribution plans? So all retirement income, including capital gains, are taxed as ordinary income when distributed, right? With the exception of if you have a Roth plan, then that income would not have that. Right? It's those gains are not taxable. But for all the other ones, we're dealing with ordinary income, which is a little unusual, right? Because if we go back to the comparison plan where we just buy investments ourselves, we buy them with after-tax money like Roth. But then if we end up paying taxes, we're paying the capital gains rate, not the ordinary income rate. So the fact that it's ordinary income is a disadvantage. There's a 10% rule for withdrawals before 59.5. So basically, you can pull money out of retirement well before retirement, even if you're not retired, but there's a penalty, right? You get taxed and you pay a penalty. So it's very expensive to pull money out early. And for the plans where the money was contributed with pre-tax dollars, or at least it's possible for that to happen, right? The government is interested in getting paid at some point, and so there are mandatory annual distributions once you hit a certain age, 70.5, right? So they say, all right, well, you've been investing and reducing your taxes by paying into this fund, and we've let you reduce your tax by this amount of money year after year after year after year, but it only makes sense for us to do that if there's some kind of payoff for us, and that's going to be in the form of large tax bills as these funds are distributed, right? So the government has a vested interest in making sure some funds get distributed out of these accounts. So there are mandatory distributions beginning at age 70.5. For some, right? For things that have this tax treatment, right? So again, if you're a Roth, the government doesn't care if you take it out or not because they already got their tax a long time ago, so it gets a different treatment. So within these, right? So these minimum distributions begin at 70.5, and then the distribution also depends on this on a life expectancy table, right? So it's sort of interesting because these don't, right? Every year you live does not decrease your life expectancy by a year. It's actually less than that because every year you live, you certify yourself as a healthier person, right? If you made it to 74, you might be better than a person who only made it to 70, right? And that means even though you got 4 years older, your life expectancy didn't decrease by 4, it decreased by something a little less. Um, so, right, so we get these distributions that we have to do, but we probably want to do distributions sometimes in general anyway. So what are some ways to get distributions? So you can get a lump sum, so you get a big payment. You just make a request and get it. Usually you're only allowed to distribute every 3 months. You pay the taxes right away. If there's a penalty, you pay that right away too. And since these withdrawals are in the hand of the employee, there may not be money left in retirement if they do too many lump sum withdrawals if it's not a plan, right? So these are just random checks as decided by the retiree. Another option is to purchase an annuity, right? So you pay a large sum up front to an insurance company, and then they promise to pay us, a series of payments. And so that's good for planning and tax because you know exactly how much you're getting, but you will pay tax on those payments every year. So there's and because you're buying an annuity, generally there's no cost of living adjustment. It's just a constant stream of payments, and so that means in practice the value of your retirement is decreasing. So rather than taking it all out and buying an annuity, you can periodically take money out. So there's because you haven't taken the money out, there's no guarantee for how many payments, right? In the annuity case, you take whatever money you have, buy an annuity, that's how much money you'll get every period, probably every month until you die. In this case, if we're taking periodic payments, then we may run out sooner or later, depending on the size of the payments and the investment portfolio returns. So that means we have no assurance of lifetime income. It might run out. And then we might have high taxes because if we're doing large distributions, we might push up into a higher tax bracket. And again, these are ordinary income, so that can get expensive. So last option for if you have a 401k or for whatever one of these plans is to roll it over into an individual. I mean, it's kind of like an individual IRA, but it's a special one specifically for rollovers. So it's basically a conversion from the one type, right, the employer qualified type, into an individually managed type specifically to accept these kind of funds. And at that point, it's your account rather than an employer-sponsored account, so you have more freedom towards how you direct the assets. And you still get the tax deferral just like you would if you had left it in the 401k. And so those are all different distribution options for these employer qualified salary reduction plans. So yeah, that's it. That's the sort of the spectrum. So where we didn't get to yet, or we didn't go, is we didn't get into the small business stuff. So that's where we're going next. We'll take a look at some of the options available for individuals and small businesses.